If you're an income investor, you're probably staring at these two tickers, JEPI and SPYI. They are the titans of the monthly income. And you probably ask, who is the best for a retirement account? Well, we're going to cover all of that today in today's video.
Hey everyone, welcome back to the channel. I'm Doug, the Retirement Guy, and today we're putting two superpowers up against each other. JEPI and SPYI. They are the titans of monthly income payments out of the S&P 500 category. Now, here's the thing that's happening. We are not going to be sitting there saying, this one's better than this one, or that's one, you need to have this one, trash the other one. We're not into this. What we are talking about here is, can these two funds work together for a better alternative? Or should you have them independently? It really comes down to what fits best in your portfolio. But here's the one thing. We're talking about this being in retirement accounts, not just, in investments, but into retirement accounts like your IRA or a Roth or a 401k. So what we want to make sure we're always doing here is we want to pick which is the right one that works into the system. Because you may be paying for a superpower that's not even being used. So may have you confused, but we're going to explain it all here today. Let's get into today's video.
Now, before we go any deeper, I got to just give you guys a pre-warning that this video is really for educational. I am not a financial advisor, so past performances don't guarantee any future results, and this is for educational. If you need financial assistance, always contact a financial advisor or professional. So let's introduce you to the two different funds, JP Morgan's Equity Premium Income ETF. The way I always put this, I always like to think of JEPI as a shield. And JPI doesn't buy the entire S&P 500. It handpicks low volatility, defensive stocks, and are really boring stocks, stuff like Coca-Cola, Progressive, and it sells covered calls to pay you, but it caps your upside. So basically think of it, if the market is going strong and increases up like 20%, JPI will be lagging behind it. Now, is that a good thing, bad thing? Well, it's covered call package, but here's what they do differently. Without doing the whole S&P 500 index, they're only selecting select funds. They use a lower volatility, pay that monthly income, and they do it by equity-linked notes. Now, this fund came out in May 20th of 2020, so we're well over 5 years old already. And this has been a lot of the commonplace in many, many retirement funds. Now, the other fund that we're going to look at, though, is the S&P 500 NEO's High Income ETF. So now I want you to think of the SPYI as your growth engine. It owns the actual S&P 500. Unlike JEPI, it uses the call option spread. It's a fancy talk for saying we pay you income, but we leave room for the stock price to go up. SPYI captures the bull market rallies that JPI doesn't. Now, they still use a covered call spread approach, but they're also using it to try to gain momentum in growth across the board. So let's break down, go underneath the hood a little bit more with the JP Morgan Equity Premium. $43 billion in assets. Like I said, this thing's a cash cow. It has been huge in the marketplace. Expense ratio, 0.35%, very low. They have over 740 million shares outstanding. Now, a lot of people will always chase this. This is the one thing I always want to hold people back and say, man, dividend yield. Chasing that yield, 8.03%. Okay, it pays out $4.74 annually, and that can always change. So don't always just mark your calendar. It's always going to change. So a total return on this fund is 8.33%. Now we take a look at what happened on April 2nd. They had the big drop off. Has it recovered? It's basically taken the rest of the year to recover, and just here in January, February, has it broken through that little barrier. So it's actually over 1 year's down 0.32%. That's why we show the growth as a negative. When we look at the long-term performance of the fund, you can see since inception, again over 5 years, is 12.15% total return. 5-year average 9.99, 1 year 8.33. And you can see as doing on the filming here, 1 month and year to date, 3.7 and 1.9 respectively. So this is not going to be your largest income generator. It's not going to be your huge, market. We said that earlier, but it's going to be a consistency that you get through. Now, when we bunch over to the NEOS S&P 500, again, $7.7 billion. This thing is managed very well. Expense ratio, almost double, 0.68%. Okay, 147 million shares outstanding. Now your dividend yield of 11.81%, paying out $6.16 per share. Again, those numbers can always change, but look at the growth. This thing had the same drop off April 2nd as most of these funds will have. It did recover back up fairly quickly, but it's maintained its level where it's at in a stale market. 0.56% growth into the fund. So you can see where we talked about where this one has a little bit more upside, a little more growth to what's going on, but also generating more yield. But remember, we're not chasing yield with these funds. We're looking at total returns. So when I take a look at total returns, we're at 18 or 13.53% compared to the 8% of the other one. There's a 5% gap between the two for increase. Now, since inception, remember this one came out in 2022, so we're only about 3 years into this fund. 14.16% since inception, 13.53 over the 1 year, and then 0.31 year to date and down 0.93 for 1 month. So you can see the fund has definitely more yield, more income with a little bit more growth than what JEPI was doing. So let's take a look at what the differences are in the strategies between these two. So the underlying stock of JEPI, and remember, we said this is a defensive play. It's active, low volatility, and it selects those, defensive stocks with lower beta rather than the full index, which is what SPYI does. So JEPI is built to survive crashes better, while SPYI tracks the broader market. Income engine, the equity-linked notes. It's a complex instrument that mimics sell and call options to generate that monthly cash, while SPYI actually uses call option spreads. So the SPYI spread strategy allows for uncapped growth potential compared to single stocks because they're doing it across the entire spread of the S&P 500. Upside capture. It's limited on JEPI, while it's partially captures about 70-80% of the rallies because of the long calls that they use. So in strong bull markets, SPYI is definitely going to be the better package. Downside risk. Cushion the downside for JEPI. And SPYI just gives you the pure point-blank market correction. So JEPI acts as a portfolio stabilizer doing volatility. Okay, so you can see where you have a 50-50 blend between what's come up. Underlying stocks, income engines, capped upside, and downside risk. Now let's talk a little bit about the performance and costs. In the tax-sheltered accounts, the expense ratio becomes the pure drag on returns without SPYI's usual tax offset benefit. While SPI offers a higher income potential, JEPI provides a lower cost defensive stabilizer. Again, expense ratios, JEPI wins with that 0.35% versus SPYI's 0.68%. So you have more principal working for you with JEPI. Now the targeted yields, SPYI targets the higher level at 10 to 12%, while JEPI's 7 to 9% is definitely lower. So SPYI will generate more raw cash flow for accumulation. And then market behavior. SPYI captures more upside in the bull markets while JEPI cushions the downside in bear markets. So you're always questioning who's better, who's not across the board. Now the taxes. Now we all got to pay taxes. But this is one of the things that makes SPYI shine. The tax trap. A taxable brokerage account, SPYI shines due to the Sections 1250C contracts offering favorable 60/40 capital gain treatment, which means a majority, 60% of your distributions are coming to you as capital gain long-term investments, which will reduce your tax burden, while the other 40% is at short term. Now, JEPI uses a totally more confusing mess, which is a portion of JPI's distributions may be qualified dividends, taxed at lower long-term capital gains, 0, 15, or 20%, depending on your bracket. Very similar to what SPYI does with those 1256 contracts. In most years, the largest slice of JEPI's payouts is ordinary income, which is taxed at regular federal tax rate, which is anywhere 22, 24. I think it's up to 37% now. So it's not more favorable of qualified dividend tax rate. So however, though, this neutralizes if everything's in an IRA package. If it's in an IRA or 401k, a Roth, everything gets neutralized because you already have that tax shelter. So again, when we get down to the side by side, the best fit. Retirees with the IRA and Roth, tax inefficiency doesn't matter. While if you have just a plain Jane tax brokerage account or an IRA is in focus purely on growth, then SPYI actually has that little advantage on that side. Clear winner expense ratio is going to JEPI because of that 0.35% versus 0.68%. The risk profile, you definitely have a lower beta, so we could at a low level, less volatility than the marketplace. SPYI has a higher beta, which means it moves more with the S&P 500. So if it goes down today, your SPY is probably going to go down. If it's going up, your SPY should go up. Bull market underperforms significantly in that capped area. JEPI is capped, so you don't get that growth, while captures upside with SPYI because of the way they set up their call options. Bear markets, boy, it's going to be JEPI because of far less fall off than what you find in SPYI. Targeted yields, we talked 7 to 9, 10 to 12. Definitely SPY is the higher yield. But remember, we're not chasing yield, we're chasing total returns. And option strategies, you got the ELN notes versus the 1256 spreads. So as I told you, total returns is the big piece of the puzzle. So a 1-year total return, and I'm going to start here on a 1-year chart, but look at what happened. Now in the brown line is SPYI, the blue line is JEPI. So let's go all the way back to April 2nd, which is the big drop off on the left-hand side of the screen. You see the blue did not drop as deep as SPYI did. SPYI dropped dramatically because right off the bat, JEPI was higher total return at the start and then dropped off. But now look at the recovery. This is where that capped side comes in. JEPI has not been able to grow as fast as SPYI did in that recovery. So everything I just explained to you is actually on this chart. The protection of the downside, the capping of the upside. So when we get all down to it, you were able to achieve SPYI's 13.53% total return versus JEPI's only 8.33% return. And why is that? It's because of the capping of the portfolio. So which fund belongs in your portfolio? Well, it really depends on your timeline, and I'll give you my opinion at the end. If you're trying to preserve phase, if you're already in retirement, you're trying to preserve your net assets and all that, JEPI is probably the better choice for you because of that lower drag of that 0.35, the defensive beta that you run into, and the primary goal is reliable monthly income in paying your bills while keeping your drawdowns to a minimum. Now, we'll say if you're in the accumulation phase, like 5 years out from retirement, SPYI is probably your better choice. Is because you're capturing all the growth of the S&P 500 between 70-80% in bull rallies. You're going to get a higher yield of 12% for that targeted yield. You definitely have a higher total return across the board. And your primary goal is the snowball effect. Long horizon allows you to absorb that higher volatility. Now, as I told you, my opinion at the end. Now, remember, I am not a financial advisor. I've only been retired for now 10 years. I actually have both. And you'll ask why. Well, I want the protectiveness of JEPI. I want that defensive mode. But I want the income that SPYI gives. And I'd like that little extra growth that possibly it has. But here's why I use both of these funds. And it's exactly that. My defensive shield is JEPI. My income comes from SPYI. Together, I think they are two massive powerhouses that a retirement package requires. You need the protection one, so you don't always need all the big yield, but you also want big yield because you want to pay and live retirement comfortably. So in my book, both of these are in my personal retirement accounts. I use them on a regular basis. I recommend and tell people I would put it into it because of how I've done it. So let me know what your thoughts are. Are you a JEPI? Are you SPYI? Or are you actually a combination of the two like myself? I'd love to hear from you. And if you like the way I did the portfolio and laid this out, let me know so we can do more videos that you enjoy.
Thank you for watching. Press the like button, hit the subscribe button, and join. Leave any comments